Dear friends of Grey Rhino, I'm very happy to be seeing y'all once again. In the last two Grey Rhino video, we talked about the first two factors of macroeconomy, and that is interest rates and liquidity. Today, we'll be talking about the third factor, which is economic growth. And historically speaking, economic growth has been the biggest factor that drives stock market prices over time. And hence today I'll be sharing with you my view. What do I think will be the economic growth in this year and beyond? And I'll say as you listen, feel free to share your comments. Whether you agree, you disagree, or you have valuable comments to be sharing, please type them below so we can really communicate. My view of economic growth in 2021 is I think growth is going to pick up. And the reason of that is largely because last year, growth had a big decline. And this year, in order to go back to the normal states, growth has to pick up. And that will be further exacerbated by two factors. The first factor is pent-up demand. That is part of a human being. The longer we get deprived doing something, and when we get to do it again, we'll do it to a certain level, excessive. If you can't go traveling, and now the ban is lifted, we can go travel again. We'll start to book our trip, travel more than usual. So that is part of human nature. So I think that will happen as the vaccines take effect, and more of these social, economic activities can be carried on. Secondly, is this fiscal stimulus which the new president Joe Biden is trying to put into place. So now he's trying to get the Congress to approve 1.9 trillion fiscal stimulus. And when this fiscal stimulus is being put into effect, again it's going to have a steroid effect, which will boost up short-term economic growth. However, I think after this short-term steroid effect, after the economic growth has normalized, I think longer term, economic growth is going to slow down. Like what we've seen after the Great Recession from 2009 to 2019, which was the slowest post-recession recovery, which averaged in US about 2.3% per annum. Because I think the COVID-19, if anything, will be slowing down economic growth, not speeding up. And generally, growth has been slowing down the last 10 to 15 years because of three factors. The first factor is that of aggregate demand. In the economy, if the demand is shrinking, growth will follow. And for most wealthy nations, they are facing lower fertility. With lower fertility comes an aging population and a shrinking population. And that leads to a shrinking demand. And this trend has been going on and I think will continue. And secondly, the last time the world saw a fast economic growth was from early 2000 until end of 2007. And the reason of that was because China was growing fast. And China being a big country, as it's growing up very fast, it pulls up the world economic growth. However, currently I do not see any of such significant economy that's growing very fast that has the significant impact on global economy. And the last factor, I call it the debt trap. What is the debt trap? For example, if you're a chocolate lover and now I give you a bar of Toblerone chocolate, how will you feel? Upon your first bite, it's going to be heavenly, isn't it? And as you consume the Toblerone, the second bite, third bite, fourth bite, how will you feel? It doesn't feel as good anymore, although it's still the same Toblerone. By the 10th bite, you almost don't feel like eating anymore. That is called diminishing marginal utility. And that works the same for debt. When debt is first churned up to fund and put into the economy, what happens is it goes to where the funds, the businesses and companies that needs this fund the most, to fund the productive assets, that will spur economic growth. However, beyond a certain point, as debt gets churned out and being injected into the economy, the companies and businesses that really need this money is already fully funded. They don't need this money anymore. And where will this money go to? It will start to go to unproductive assets, or the zombie companies. Yeah, where by nature, these companies should by right go out of business. But because of this cheap and easy money, it puts them on life support. Yeah, but they are not thriving. They are merely surviving. And hence such companies do not help to spur economic growth. Yeah, it's because of reasons like what I've shared that I think the next 10 years will be more of the same, that of slow economic growth, because none of this factor has changed. And as I said earlier, economic growth is one of the major drivers of corporate profits, which will then drive stock market prices. Then does it mean with slow economic growth, corporate profit will slow down and hence stock market price will be slowing down? Well, I think it might not be so, because we are entering, or we have been in a bipolar world, which runs at different speed. One part of it, these companies, I call it the structural growth companies, or the disruptors. So these companies has been growing fast, and I think they will continue to benefit from this trend. Because they don't need fast economic growth to grow their profits, because they are growing by taking away market share from the existing company as they disrupt them. Then let's talk about the second group of companies. This second group of company is going to face a difficult time, because as they get disrupted, not only they face a slow economic growth, they face a substitute or a disruptor that is disrupting their business. And hence that's where we got to be careful about this category of companies. So I said, if you want to have a fast growth in a portfolio, you may need to look into at least some of these type of companies to help to spur the growth in a portfolio. However, as I shared in the last video, a lot of speculation is having in this group of companies, because all this cheap speculative money is pouring into this group of companies. And hence, as I reiterate, in this group of companies, there are two types. One, where their success is already a reality, and one, where their success is still a probability. Invest only in companies where their success is already a reality. So their real revenue, real profit you can count on. Of course, some of these companies will go on and be fantastic. But the question is, do you know which one? I don't have a good guess, and hence I don't try to speculate in this area. So that's really what I like to share about economic growth and how you should be positioning your portfolio in a situation like this. So I really wish you well, as you're listening during this Chinese New Year period, that you will have a year of prosperity, of success as you go about managing your own investments. Thank you very much. If you'd like to be listening regularly to the Grey Rhino YouTube to gain more financial knowledge and also investment wisdom, do subscribe below to the Grey Rhino YouTube channel and remember to turn on your notification.